Hi everyone, this is Niranjan Avasthi, and today I welcome you all on this interactive session where we will talk about a very unique offering of Edelweiss MF, which is recently listed IPO fund. The journey of this fund has been very interesting. It was launched in 2018, and I remember IPO markets were booming and doing very well. Initially, to test this idea and see, how it works out, this fund was launched as a close-ended fund, and after it completed almost 3.5 years, we converted this fund into an open-ended fund so that we open this opportunity for all your investors to invest. So today, to discuss more about IPO markets, what kind of stocks we have in our portfolio, how this fund has done, and what lies ahead, we have with us Bharat Lahoti, who is the fund manager and also co-head for our hybrids and solutions funds, and we have Bhavesh Jain, who is again the fund manager along with Bharat on this fund and also co-head for our hybrid and solutions funds. So welcome Bharat and Bhavesh for this interactive session. And I'm sure, a lot of people out there would be having many questions around this fund because it has seen a quite bit of volatility in last 1.5 years. And recently now again, it has come back very strongly in terms of performance. And, it is also on the back of very strong IPO markets. We've seen companies getting listed again at 60-70% premium to their IPO price. So a lot of happening in this space. So let's start with you, Bhavesh. Can you just briefly talk about the fund strategy and what actually it tries to do and what problem it solves for investors?
Thanks, Niranjan. Yes, I think this is a unique product wherein it is a thematic product where we try to explore, or you can say enable all our investor to get this opportunity to participate into the company in the early journey of the, you can say in the early period of the journey. So it is a thematic fund wherein 80% of the AUM is deployed in last 100 IPO, which we call it as recently listed IPO, and remaining 20% can be into other securities. So like if there are say 20 new IPOs, 20 old IPOs move out of the universe of the last 100 IPO, but we can still stay invested up to 20% of our AUM in those IPOs which are out of 100. The most important thing what we wanted to achieve when we launched this fund earlier as a close-ended one and now as an open-ended fund was to give three benefits to our investor. The first one was you can say right access. All good IPOs are getting oversubscribed by say 50 times, 100 times, 150 times. So a retail public or retail investor or maybe an HNI try to participate in that journey, but he hardly get any allocation because it is a lottery system. And even if he gets allocation, it is like say 14,000 or 15,000 rupees if he gets a single lot. So he's not able to get, you can say, right access to a good quality IPO company at the time of listing. Then the other way to participate is that he will say that anyways, I put money into mid cap and small cap. And as more and more IPOs are mid cap and small cap oriented company, any good company over a period of time will become part of my regular mid cap and small cap portfolio. But again, there, if you will evaluate our portfolio, say that is last 100 IPO, it will be at least 80% of our AUM. If you look at any other mid cap or small cap fund, that last 100 IPO will not be more than say 2% or 3%, or at max say 5% of individual mid cap and small cap fund. So you don't get access even through your normal mid cap and small cap fund. And by the time these stocks become part of your normal mid cap and small cap fund, you have already missed the earlier, you can say, easy part of the journey, wherein the stocks are already say 2x, 3x, 4x, and then they become part of your benchmark, your peer portfolio, and then your normal mid cap and small cap fund. So you miss the initial part of the journey. Second important thing, what we wanted to achieve was right selection. As you said in the beginning that today IPOs are getting listed at 50%, 70%, 100% premium. Looking at this, then people start participating in each and every IPO. And as a result, in good IPO, you hardly get any allocation. And in some of the IPOs where you will get maximum allocation, listing will be very bad. And as a result, finally, the you can say investor will burn his finger by getting all the wrong IPOs in his portfolio, and then again, it is like you will blame the IPO market or the equity market. So that's why if you will see, even after having a dedicated IPO fund, out of the last 100 IPO which come, on an average, we put money only in 35 to 40% of the stocks. That means even in a dedicated IPO fund, we are still not touching almost two-thirds of the universe in our fund. That clearly shows that right selection is very important. Today, most of the IPOs are getting listed at premium, but even now there are some IPOs which are, you can say, hardly are able to meet their listing price in last 6 months or last 1 year. So that's why right selection is also very important. And the third and the most important objective which you want to achieve is post-listing gain. Normally, people think that IPO is nothing but everything about listing day gain. Like today, stocks are getting listed at 50%, 70% premium. Uh, and then people think that if I get allocation, I will sell it on the listing day, I will make 60, 70, 80%. But if you will see, when it was a close-ended fund and we gave a CAGR return of almost 20 to 23% in that 40 months window from February 2018 to June 2021, the fund delivered close to 23% CAGR. Out of that, listing day gain was only 1.5%. That means remaining 21.5% returns were made by deploying into the stocks, by selecting a stock post listing. So that 1.5% was purely because of luck, where we got an allocation or others would not got have an allocation. But the remaining 21.5%, which are the returns of stocks post their listing, are easily achievable by each and every individual. So that is something which you wanted to highlight, that IPO is not about listing the gain. So you should not only get happy with a 50% or a 70%, you can say, pop on the day of listing. Actual money or the real money or real wealth is getting created by holding the stock, good quality stock for a long period of time, so that you made a much better return compared to what you get on the listing day. Just for an example, DMart IPO came at 300, listed at 600. On the day of listing, you were sitting on 100% profit. If you would have exited on that day, you would have missed that entire journey from 600 to say 3000 or 4000 or much higher. So this is just an example to showcase that IPO is not only about listing again, real wealth will be created if you stay invested in a good quality company for a reasonable period of time to get the true potential of the stock price.
Yeah, Bhavesh, and your point, just to add to your point that selection is very, very important. Just to showcase that, if you look at the benchmark which we have for this fund, which is India Recent 100 IPO, last 5 years the CAGR is 6.5%, and the fund Edelweiss recently listed IPO fund CAGR is 15.88%. Alpha of almost 9.5%. And hence selection becomes very, very important. As you mentioned, two-thirds of the universe you have not invested over the last year or so, many, many years. Also, this strategy has a huge alpha over a broader market. If you look at the 5-year CAGR of Nifty is close to 12.5%, and the return of this fund is 15.88%, almost 2 plus percentage of alpha. That also because many new age kind of companies or sectors which are not present currently in the market are getting listed. And hence, I now want to invite Bharat to talk more about these kind of opportunities. So Bharat, just to start, first of all, after I think so many, many months, I would say, if not years, IPO markets are looking very good, at least in terms of the number of listings, and also the main parameter with which we, gauge the health of this market is the listing premiums. Recently, a stock got listed at 60-70% premium. Couple of weeks back, also we've seen. So, what's going on in the IPO market, and how do you see the current trend in the IPO market?
Great. Thank you, Niranjan. And good afternoon to everyone. Just to give you a sense, IPO market will move in, will have an ebbs and flow kind of stuff. There would be good quarters where there would be many IPOs. There would be quarters where there would be very fewer IPOs. And it's primarily dependent on how the capital market behaves. So as equity markets are buoyant, we'll see a lot of IPOs coming in, and equity markets are not so great, you will have a fewer IPOs. Having said so, it doesn't mean that when the equity market are not so great, the IPO markets are not good to that extent, because if you look at it, FY22, if you look at it, market was bit sluggish to that extent, especially in mid caps and small cap, but we had seen good number of IPOs coming in. Just to give you a sense, in calendar year 2022, we had seen closer to around 39 IPOs. And these companies now, if you look at it from a 6 month perspective, which is from January to June kind of stuff, they delivered 28% return. So I'm just saying, despite those IPO coming in a very bad time, these companies have delivered great set of numbers to that extent. And if you look at it, how it is market is looking from our perspective, the IPO season typically starts with a bang, which we have seen in last 3-6 months kind of stuff, where the IPOs have listed very well to that extent. And typically the IPO market also behave in a fashion where it takes around a year to actually get to a peak kind of stuff. So we have just seen 1 quarter of good IPO season. Maybe we'll see a couple of more quarters before it IPO peaks. Just to give you a sense how IPO market behaves in general, the first 2 quarters are typically a bit more easy money to be actually explored to that extent, because as soon as you see a trough in the IPO market, most of the IPO markets, IPO companies do get priced very sensitively. If you look at it, last few IPOs, whether you keep it in a hospital company which came for IPO, or whether you could see an NBFC company coming for IPO, or whether you see a bank company coming for IPO, or even pharma company coming for IPO, all these companies had priced valuation reasonable to that extent as you compare it with 2021 IPOs, which were priced obnoxiously very high to that extent. Now again, markets are different. 2021, when market was extremely buoyant kind of stuff, people were actually pricing it very well to that extent, and nothing was left on the table. Right now, there is enough on the market in terms of risk reward favorable to that extent for the IPO comes to. Second thing what we wanted to speak about it about IPO market is there is a misconception about IPO market is all about internet companies to that extent. So we just wanted to take away from it. You will have a lot of IPOs coming from different sectors. There are multiple themes in the market which are going out, and you have multiple companies coming from IPO market. Whether you look at companies in the healthcare space, companies in manufacturing space, companies in defense space, companies in financialization of saving theme which we can play around, or even companies in digitization. So I'm just saying there are enough of themes you can play in this market. So in our opinion, IPO is as a tool or as an investment strategy is a place where you can play multiple themes within the single fund to that extent. If you look at why this IPO market is very interesting at this juncture, also even why IPO outlook is very interesting, is that what we have seen in 2022 when interest rates were volatile, as interest rates were rising, a lot of valuation was getting corrected in some of these IPO companies. Now, as interest rates have stabilized, we are seeing some kind of improvement to happen. So one of the important aspects for IPO market is a stable interest rate environment, which we think is a crucial thing which has happened in the IPO market in the last 3-6 months. As interest rates have stabilized, the IPO markets have revived to that extent. And finally, if you look at it, how the IPO market looks ahead in terms of number of companies coming up for IPO, there have been 68 IPO filings which have been done to that extent. And if you look at it, almost close to around 15 companies are already waiting SEBI approvals kind of stuff, and there are enough of them in pipeline. And if you look at the composition of IPOs, again, I'm saying this is not very specific to any internet companies. We have companies even in the real estate space, we have companies in insurance, we have companies in FMCG, pharma, and I can tell you names in terms of which are there in the pipeline. Depending upon the valuation, depending upon the market conditions, these IPOs will come gradually kind of stuff. If you look at it, the kind of meetings which we are doing on a daily basis kind of stuff, we are at least meeting one company on a daily basis kind of stuff. That's the real kind of stuff, depending upon the market conditions. Right now, if you look at it on the pipeline, we have at least 8 names which are there in the pipeline, which are in the advanced stage of discussion to that extent. So IPO market looks interesting at this juncture. My opinion is typically it takes 3 quarters, 4 quarters to peak off kind of stuff. This is the first quarter which we have seen good IPOs. If you look at it, this quarter we had seen close to around 8 IPOs so far for this quarter. The first 2 quarters of this calendar we had seen four each kind of stuff. So this year has been actually a normal year. This is not a great IPO year in terms of number of IPOs, but it's a normal year to that extent. And I think the IPO market will be buoyant going forward next 3-6 months kind of stuff.
Right, Bharat. I was just looking at some numbers, and over the last, I would say, since inception, the 3-year rolling return of the strategy is the minimum is around 11%, and the maximum is roughly 30% plus. So it's quite interesting that and correct me if I'm wrong, that over a longer period of time, which is 3 to 5 years, this seems to be a quite reasonable strategy to make money for people, because a lot of these companies might come up at a higher valuation, but there is a good earnings momentum into these businesses and these companies. And that's what Bhavesh was also mentioning, that almost 90% of the returns, or in fact more than that, returns have come by holding these companies for longer period of time and not only listing gains. Bharat, in last 1 year, if you were to showcase what kind of stocks, or which IPOs have you participated, and also which ones, without maybe naming because we don't hold them in our portfolio, which ones which you had ignored or didn't invest in last 1 year?
Okay, great question. If you look at it, yes, the IPO market is not about only listing the gain. Actually, IPO market is beyond that. This is a strategy which has been followed worldwide to that extent, where you want to find multi-baggers. People question us in terms of how do you find multi-baggers kind of stuff. This universe actually can help you to find some of the multi-baggers to that extent. This is a strategy where you will find some of the value migration happening. From a small cap, it becomes mid cap becomes large cap. So that is another good universe for us to give some kind of value migration stories to play it out. Again, you are aware, whenever the IPO companies do come in market, when there is a earnings momentum within themselves. So the IPO companies do come at, I've not seen companies which have come in IPO market saying that next 2-3 year my growth is flattish, or I will have a degrowth in that company. I don't think so. Any of these companies can come in IPO market in general. So there is always an earnings momentum in big IPO companies, which somebody can ride if they identify it well to that extent. How visible is that earnings growth and how quickly you can achieve it to that extent. So obviously IPO market looks very interesting from that perspective. If you look at last 1 year kind of stuff, last year and 1 year data, if you look at it, there were 33 companies which have listed. I'm saying from June 22 to June 23 kind of stuff. We participate in 10 of those in terms of anchor kind of stuff. In this last 1 year kind of stuff, calendar year returns, the universe has given close to around, on average, on 46% return. This is return is higher as compared to the small cap index, because if you look at it, IPO companies typically get listed as a small cap index, and then they gradually shift from a small cap to mid cap to large cap, and so on and so forth. So if you compare it with a similar kind of stuff, the NSE small cap has given in the last 1 year around 28%. So I'm just saying the universe has given higher return, which is 46%. The 33 companies which have listed in last 1 year kind of stuff, if you look at it, and we have taken position in at least 10 of those or 12 of those names, and that has given our close to around 51% on an average return kind of stuff. So the performance has been good if you do selection right to that extent. Some of the areas where we have participated aggressively in last 1 year is we have seen companies in the MFI space. We have participated well to that extent. We had seen few listing coming in MFI space, or even the SME lending kind of stuff. So lending institution, but the bottom of the pyramid lending kind of stuff, where we thought the opportunity is getting better, given that what we have seen in the COVID times, people was struggling high. There has been a lot of support given by the government, and there was a recovery which was going around. So we thought there is an interesting opportunity coming in the lending space especially at the bottom of lending trees. We also participated in some of these retail chain companies kind of stuff. We thought, okay, this is an interesting idea kind of stuff. Why this is an interesting idea? If you look at it, in last 1 year, we had seen some case-shaped recovery kind of market. We had seen bottom of like in footwear, we had seen some of the companies which were catering to the bottom of the pyramid were not doing so great, but companies actually which are catering to premium segments are doing very great. Similar thing which we have seen in the apparel space. So we have participated in some of these consumer retail story to large extent. If you look at it, we also participate some in the niche chemical companies kind of stuff, which we thought, okay, this is an interesting idea to be played out. We understand this is the peak of chemical sector kind of stuff, but we thought it's a niche area where one can participate. We have been doing it. We've also participated in some of the hospital chain. We thought, okay, occupancies have rising substantially. There has been rise in the average revenue per bed kind of stuff, which it looks very interesting from our perspective, given that how the premiumization is happening. So some of the companies where we have participated is in hospital chain, which looks very interesting to us. So those are the things which we have participated in the last 1 year from our perspective. Again, just to give you a sense, uh, IPO companies, when we speak to people, people typically take few names in the IPO space, and these are names which are well talked about it, but there are many smaller names which are doing decent kind of work. And if you do well research kind of stuff, if you do selection very well, actually there is a lot of money to be made in the IPO companies.
Okay. Okay. So, if you see, it would have been quite difficult to avoid some companies and select some companies, and especially a year which we're just starting into, where maybe every 2 weeks or 1 week an interesting IPO is coming up. You just mentioned every day literally you're meeting one or the other management who is coming for IPO. So at times there is a froth which gets built up. So, and usually the notion or the understanding is whenever a company is coming for an IPO, the valuations will always be higher. So what is the process that you follow? And it'll be interesting if you can give some actual examples with names which you still hold in your portfolio. How did you select? What did you see in these companies, and the ones which you avoided as well?
So let me give you, obviously, whenever a company comes from an IPO market, there is a DRHP which gets filed with the SEBI in terms of it's a prospectus where actually the company spells out its entire history, what the company has been doing so far, what is the industry's prospectus, is there any litigation, are there any risk factors? So entire prospectus of the company gets published. It's an important document in the life of the company, in the public life of the company, to that extent, where actually it gives out the entire details of its history to that extent. The rest of the years, if you look at it, it's an add-on in terms of annual report, which comes from the company perspective, but you don't have the historical context, how the company was built, and so on and so forth. So this is an interesting document, and it has a lot of data with respect to it. So this is our starting point of our journey to analyze the company. So whenever the company files for DRHP, we typically look at that company at that point of time. With this, what we do is that we understand the company. We do a lot of financial analysis on it in terms of how the company has worked around it across time horizon kind of stuff. We try to get data. Again, whenever company comes for IPO, that is the time when the company is more open in terms of giving out more information in terms of how the company is behaving. They also do a lot of plant visit. We also meet some of the customers. We also meet suppliers. So we get a lot of access to the working of the company at the time of IPOs. I'm just saying, during a normal course of time, maybe you will not be getting so much access to the information or data in terms of it, what you can get in the IPO phase to that extent. So that is the information that we do as an institutional participant. The access is higher to that extent, since we are meeting before the IPO actually gets launched to that extent. And consequently, a lot of information gets in, and we try to segregate companies in 3 different buckets in our fund. That is the core investment philosophy in terms of how we actually analyze IPO. We segregate companies into three buckets, where the first bucket is the secular growth idea, where we have most of our exposure, like 80-85% of exposure of our fund is towards the secular growth ideas. These ideas are ideas where we think the sector itself is growing at a 10-12% CAGR kind of stuff. Companies have an advantage in this sector, given they are actually giving a differentiated product, they are gaining market share, or they are market leader in itself kind of stuff. And consequently, they will actually get disproportionate amount of actually growth with respect to sector. And consequently, our exposure to these companies are higher to that extent. Again, we think the opportunity is big, as India itself is growing at 6-7% kind of GDP growth. A sector which can grow at 10-12%, a company can grow at least 15-20% above this. So we think those companies are secular growth ideas, and we have a higher exposure to that. We also understand there are times where there are cyclical companies which do come for IPO when the market is favorable to them, like what we have seen in 2020 to 22. Many chemical companies were coming into market. We understand chemical companies do go through a cycle, and consequently we will see those chemical companies coming for IPO phase. And this is a normal case scenario where the industry is in a good shape. Most of the company would require some amount of capital for their future growth plan. So we have seen chemical companies coming for IPO, raising capital to that extent, and hence you would actually look at these companies, but with a very different lens. We will try to find a niche company within those companies. If you look at some of the companies where we have played, are some of the companies which are actually doing chemicals with a low environment concerns to that extent. We have selected companies where they are catering to a product which are they themselves are market leader with it, or they have a monopolistic kind of environment structure in those kind of company names. So those are niche companies within the cyclical sector. Also, there are companies where we understand, and I'm just saying these are the 1/3 of the companies where we think the history of the company itself is not so great. When we look at some of these analysis, when we meet some of the customers or suppliers, we tend to understand either the company has not been able to convert the profits into cash, or companies have been highly levered, or companies have history of not actually decent history in terms of promoters, or they have some subsidy which is not in the related business. So there are a lot of other quality issues, and consequently we keep this in an avoid bucket, and we typically don't participate. For us, if you look at it, the universe of last 100 companies, 20 to 30 companies would be something in that avoid bucket. So for us, the investable universe is like 60-70 companies, 70-75 companies would be investable universe, out of which we typically select 30-35 companies in our bucket. If you look at last 1 year, what what worked well for us from my perspective, if you look at it, 6-8 months back, if you look at it, there was a company in the MFI space, or the bottom of lending institution coming for IPO kind of stuff. This was a lending institution based in South India kind of stuff. A very niche segment. Again, if you look at it, they were catering to the tier 3, tier 4 towns of the South India kind of stuff. Typically lending of less than 10 lakh rupees kind of loan kind of stuff, 10 to 12 lakh rupees of loan kind of stuff. Again, the IPO was priced very stiff to that extent. It's not that the IPO was priced at a discount to that extent, given the growth was pretty solid for this company. And if you look at it, FY22, calendar year 22 market was not so buoyant to that extent. IPO markets were very sluggish. This IPO got barely subscribed. I'm just saying, if you look at the overall total subscription, it subscribed only 1x time kind of stuff. And the IPO opened decent. I would not say decent in terms of the subscription numbers. It opened up well. But if you look at post-listing returns kind of for this company has delivered close to around 60% returns post-listing kind of stuff. So I'm just saying, if you select well to that extent, the companies do well to that extent, and you could identify good multi-baggers also in the universe.
So Bharat, very well covered about different strategy and how you do the bucketing exercise. One question which is largely there in everyone's mind is, how do you analyze new age companies? The Paytms of the world, Zomatos of the world, and how did you see? I mean, we saw a couple of companies getting listed last year. Some of them did, I would say, okay. Some of them, did really poor, but now again they've come back. So how do you see this space, and did you avoid these companies, or did you buy some of these companies in the portfolio, uh, or have you bought it after that correction? Does some of these companies make it to your portfolio list now?
Good question, Niranjan. Just to give you sense, how do we analyze some of these internet-based companies where the profitability at this juncture is not there, but there is a hope for these companies to deliver some profitability. Now, if you look at this fund is a thematic fund where we invest in last 100 listed IPO companies. Typically, if you look at this horizon, last 100 IPOs, in a year, typically you will get 20 to 25 IPOs. And that means basically the universe is for 3 years or 4 years kind of stuff for us to play around. So we actually evaluate companies based on 3 years or 4 year horizon kind of stuff, how this company is going to work around it. Few companies actually interesting thing is that in an IPO market also you have to avoid companies as compared to selections. Avoiding is also an important investment strategy while as important as selecting also. So one has to think about it, whether these companies would be able to deliver profitability in near term or not. So some of the companies in this space have actually been struggling in terms of delivering profitability in near terms, and consequently we have avoided it. We thought that many of these companies in the near term would find it very difficult to deliver profitability. Uh, so we have avoided some of these names. Maybe in out years, these companies would probably deliver some of the profitability, but for us in our time horizon for 3 to 4 years, when we don't see any profitability signs of profitability, we typically tend to not touch those companies to that extent. Obviously, we have participated in few of the internet names where we thought they are actually operating in a very niche segment. Some of the beauty product company we have participated. Some of the insurance online insurance company we have participated. Some of the online food delivery businesses we have participated. But that these are unique companies to that extent, and consequently we thought these companies actually are generating good set of businesses in their core market, but they are investing in some of the ancillary market or the adjacent market, and consequently their profitability is down. As soon as they will stop actually investing in some of the ancillary, they can actually be profitable. But if they want to be bigger in the size, they have to invest going forward. So we thought this is an interesting idea from our perspective. If these companies are able to actually establish one more line of business, could be an interesting idea. Just to give you a sense, the beauty online beauty company kind of stuff product company was profitable in the beauty products category to that extent, but it was investing in some of the space in the fashion segment kind of stuff. Now fashion segment is a tough segment to crack. It doesn't happen overnight kind of stuff. It takes time to that extent, and we have to give some amount of leeway for these companies to actually come up to that phase. So we think it's an interesting idea. As an IPO fund, we tend to actually participate in some of the new dimensions or new themes which are coming in the market. There are times where these themes will play out in 1 year, 2 year, and sometimes 3 year kind of stuff. And we have to be patient enough of understanding these themes can be very big if they fructify to that extent. And in a fund, we would like to participate if there is a multi-bagger story which can build up in next 3 years kind of stuff. And hence we have been doing that.
Right. Thanks, Bharat. Before getting more into the portfolio, I want to go to Bhavesh now. Bhavesh, if you see, while the fund did really well compared to the benchmark on a relative basis over a long period of time, or even recently, last 3 years and 1 year, but there was a patch till last year where, on an absolute basis, or as compared to maybe a broader market, the fund was not doing so great. So what were the reasons behind this? And, what to expect when such kind of, downturn in terms of performance comes into this kind of strategy?
Yes, Niranjan, as you would have seen, the portfolio is tilted towards mid cap and small cap. So almost 85 to 90% of our portfolio is into mid cap and small cap. If you will see from bottom of, you can say, COVID correction, that was somewhere in March 2020, the close-ended fund was, you can say, got converted into an open-ended fund in June 2021. In that period of, you can say, roughly say 16 to 17 months, NAV of this fund from close to 7.5 went up to 22. That is 200% return in less than 16 17 months. And as the result, valuations were already stretched. In addition to that, after that, because you can say such a nice journey was going on for most of the IPO names, all the incremental IPOs and the promoters and the lead manager started, you can say, pricing IPO very aggressively. As a result, on day one itself, there was nothing left on table for, you can say, any investor who will participate in those IPOs. And that was the period where some of the, you can say, new age technology names and one of the large, you can say, insurance player and all of them got listed. And we have seen even now, after say almost, you can say, 15 18 months, still they are not even there a break even price. That was the period where overall IPO theme took a beating because of higher valuation. In addition to that, after that, you will see Ukraine, Russia geopolitical issues started, US inflation and interest rate situation deteriorated further. And as a result, growth as a theme took a beating. So now when you look at IPO stocks, it is a, you can say, combination of a high growth company which got impacted because of higher interest rate. Then it is a combination of larger exposure to mid cap and small cap, which saw a carnage not only in IPO but overall broader market also. Mid cap and small cap corrected much more compared to large cap. And as a result, IPO fund, or you can say our fund, took a, you can say, a big beating, wherein NAV from almost peak of almost 22 went down to 14 and a half, 15. This you can say is a combination of, as I told you, this 3 or 4 reason, wherein good IPOs were not available. Those IPOs were coming were very rich valuation, very expensive valuation. Existing IPOs already were sitting on a gain of 100%, 200%, 300%. So some drawdown and some correction happened over there also. So these 3 or 4 factors coming together led to the underperformance last year. But now you will see, once interest rate had stabilized, inflation has again, you can say, not normalized, but compared to what it was say 1 year ago, things are much better in global markets also on inflation front. Again, because of which we have seen FIs flows have also turned positive, and we have seen a decent recovery in mid cap and small cap. So all these factors which were, you can say, detractor last year are again now the contributor for this particular year, and we are seeing this decent recovery. See, the interesting part is, even in the tough period of last year and in even today, portfolio of these companies are still showing an earning growth of anywhere between say 25 to 35%. And finally, see, in short term, stock price can move in random direction, but over a 3 to 5 year period, stock price are slaves of earning, and they will chase the earning. Even now, when you look at, you can say, latest portfolio stats, you will find that our portfolio growth, both revenue as well as profitability growth, is in the range of 30 to 35%. So over a period of time, finally you will get decent return. But yes, whenever there is a euphoria kind of environment, if someone enters at that point of time, he may suffer, or he may take a longer time to recover his initial, you can say, investment. But if you are able to time it perfectly, looking at, you can say, historical context, in a limited history of last 5.5 years, this fund has seen a 20% plus drawdown 4 times. So that itself shows that it is a very, you can say, mid cap and small cap oriented portfolio. So a lot of volatility in line with all your normal mid cap and small cap fund. But as far as earning growth is concerned, as far as revenue growth is concerned, I think this is a portfolio which is much better compared to your traditional mid cap and small cap stocks. So in that context, if you are there for 3 year, 5 year you can say, kind of period, you will never be getting disappointment. As you rightly mentioned, minimum 3 year rolling return is close to 11%, which is in double digit, which I think is like average return of equity over a long period of time. That is the minimum return we have given, even after 4 times seeing a drawdown of 20% plus. But like every time, this time also recovery has been very sharp. It is purely because of, you can say, higher earning growth, which will, if you give time to this fund, will definitely lead to higher returns.
And very rightly said, Bhavesh. If you I want to add one or two more points here. If you look at the portfolio, the active share of this portfolio is quite high compared to any other, maybe a flexi cap fund or an SE 500. We were looking at some data. The number of IPOs, or the percentage of portfolio exposure into recently listed 100 IPOs, on an average in flexi cap fund, it's close to not more than 10%, on an average 7 to 10%, whereas your 80% of that portfolio is into these recently 100 listed IPO companies, uh, which shows that this universe is this portfolio of universe is very different from an average flexi cap or a large and mid cap or a multi cap diversified mutual fund, and even broader market, which is NSE 500. So yes, as you rightly said, Bhavesh, there would be bouts of volatility. There would be a huge tracking error of this fund's performance vis-a-vis average, equity funds. And the only way to, cover this up is by staying invested longer period of time. A 3 to 5 year is an ideal time horizon. And also the another point is, what we can make out is it has a high correlation of in terms of performance with mid and small cap as a universe, because almost 80% of the universe is into mid and small. So you'll have to wait for that thing to play out. Even if you have good stocks, good themes in the portfolio, one will have to wait for mid and small cap to perform, because that is where most good businesses which are yet not out there or have not become large cap would shine and do much better. And that's where alpha is generated. That's how the alpha has been generated over a longer period of time. Bharat, coming back to you, Bhavesh has explained very well how the performance was down and why it was down. So now we have seen a nice pickup in the performance. So how is the portfolio currently positioned? What kind of themes, what kind of sectors one could expect this portfolio to have, and what one should expect over the next couple of years, if not quarters? Bharat, I think so you're on mute.
Okay, so just to summarize in terms of why this fund is very interesting from our perspective and why one should look at this fund and what are the themes what we are playing in this fund. This is again a fund with multiple themes one can play around. We have thematic funds where somebody's concentrating on a manufacturing sector, somebody's concentrating on technology, somebody's concentrating on BFSI space, but this fund has a multiple legs for growth. As India is going to go from a 3 trillion to 5-6 trillion economy, you will have multiple sectors, multiple companies, multiple themes which will come up. If you look at in current avatar, what we are playing aggressively is manufacturing theme to large extent. If you see in our portfolio, we have some of these EMS companies, some of the chemical companies, some of the auto ancillary companies, some of the electrification of the kind of companies which we are playing around it. So we have enough exposure to some of these manufacturings or defense themes to that extent. So I'm just saying that is one broad area where we are playing around. We have also some of these schemes where we are playing in some of financializations of savings. We spoke about it, some of these lending companies, especially in the NBFC space, especially at the bottom of pyramid, where I think the lending is very prime important to it. We are playing that theme as well. We are also playing some of the consumer stories through a different way. We have companies where we are playing luxury goods like luxury cars. We are also playing companies in the healthcare space where we think as we are the per capita income increases, the healthcare requirement would increase substantially, and consequently we are playing some of the healthcare companies in our portfolio. We are also playing some of the companies in the retail space where we think the urbanization will actually drive some of the retail spending to large extent. So we are playing whether through QSR, whether through apparels, whether through footwear. So there are different multiple themes which we are playing in this market. Two things which we need to know in this fund and what one should expect is this fund will have higher mid caps and small cap, which Niranjan has and Bhavesh has pointed out. That is important part of it, and you have to think this fund as a proxy or a diversified version of any mid cap and small cap fund to that extent. Second important thing is this fund is not looking for value kind of approach. We are looking for more growth quality oriented companies within that space to that extent. So at that point of time, I'm just saying chasing value in this universe is not advisable in terms of it, because there are times where value becomes more value oriented. I'm saying you can get into value trap in many of these companies. So this fund is all about growth quality. This fund is all about the new age companies. This fund is all about the mid caps and small cap, where there could be value migration from a small cap to mid cap to large cap. So those are three areas where one should think about it. This fund is an interesting proposition because it adds value to the existing mid caps and small cap universe in terms of diversification. This fund also adds in terms of uh, uh, getting an access to early access to some of the companies which eventually get listed in the some of the passive funds in the indices to that extent, whether it's an FT, MSCI, FTSE indices. These companies come gradually over the next 6-12 months, but this fund gives you an access to some of these good companies early to in the fund to that extent. So these are the advantage. Our opinion is customers should come with a 3 to 5 year mandate kind of stuff, and most probably because you have to come in an SIP through route or SIP or STP route. That would be more advisable because we don't deploy fund immediately. We actually apply in IPOs gradually over a period of time as the company shows more and more progresses. So for us, the deployment becomes very easy if the investor do come in an SIP STP route.
Thanks, Bharat. I think so. We have covered most of our questions, but yes, we do have many questions from our listeners and our partners. So let's have question and answer over the next, couple of minutes, and all participants are requested. If you have any question, do send your question through chat window, and we'll have them answer. The first question is, around valuation. uh, as you mentioned, Bharat, that at times when IPOs are booming, the valuation is not uh, favorable, or it's kind of expensive. And so how do you avoid high valuation trap, I would ask you, and how do you navigate, and also what is the current valuation of the portfolio? What are the growth numbers or the expected EPS growth numbers of the portfolio?
Okay, so it's very interesting question. Whenever the IPO market is in boom, you will have some kind of exuberance and some kind of valuation issues with respect to it. What we typically tend to understand in such kind of companies, how is the longevity of the earnings growth, whether the companies are able to actually sustain the earnings for next 3-5 years. You can have 1 year of a underperformance which can happen, but if earnings growth do catch up, for example, if the company is growing at 30-35% kind of stuff for next 3-4 years kind of stuff, even if a company actually sees a valuation dip of 30% kind of stuff, within next 2-3 years, you will still be able to make 15-20%, which is decent enough for our portfolio construct to that extent, that we are assuming in next 3-5 years, if company can deliver 20% returns, including the earnings growth plus valuation upside downside, that is good enough. So if the company is able to actually generate 30-35% earning growth, we typically tend to actually look at company more positively even in an upcycle kind of stuff. In a down cycle, obviously, where you will have companies coming at a discount, if you look at it last 6-8 months kind of stuff, many companies which are coming in the APU market are actually coming at a 15-30% discount kind of stuff. Again, I'm just saying in the IPO market, in each of the market, you could find good set of companies. Avoidance is key. You rightly said you have to avoid some of these high value companies to that extent. But having said so, if the growth visibility is very high, we tend to actually look positively for this company. We think from that perspective, if company is able to deliver for next 3-5 years that earnings, these valuation will catch up from that perspective. So we look at out years kind of stuff, next 2 years, how the valuation looks like in next 2 years kind of stuff. And if that number looks reasonable vis-a-vis the growth, we tend to actually look positively for this company. Again, to give you some sense, we have avoided many companies. I'm just to give you sense, we only participated in 1/3 of the companies. So I'm just saying the filtration process is very strict in terms of valuation also in to that extent before actually boiling down to any of these companies. The next question which you spoke about it in terms of how we want to get into it. Uh, just to give you sense why we think this is a
Bharat, I think so. You're on mute.
sorry, Niranjan, what was the question? Second question?
Yeah, so the second question was, what is the current valuation of the portfolio, and
Yes.
how are the growth numbers looking at like?
Okay. So if you look at it, the valuation of the portfolio kind of stuff, and if you look at the FY23 numbers kind of stuff, the fund has delivered close to around 26% sales growth, close to around 32% PAT growth. So I'm just saying the earnings growth trajectory has been very strong for this fund kind of stuff. And when you look at valuation for this fund, if you look at it, this fund in terms of P ratio for this fund is closer to around 33 times. So when you look at P to J ratio, we are closer to like 1.1, 1.2 times on a 1 year forward basis kind of stuff, which looks interesting. Now, why this is interesting, just to give you a sense, as we were standing in December 21 kind of stuff, the P to G ratio for this fund was closer to like 1.7. This has come down substantially over last 1 year kind of stuff to 1.1, 1.2. We think is an interesting proposition when P to G ratio is around 1.1 times, and an interesting idea to play this fund.
So, are you saying that most of the time, the valuations have been on a higher side for most of this portfolio companies or at the portfolio level? But what has been more, impactful is the underlying earnings growth. So, you said the underlying PAT growth for last year was close to 30%, right? If I'm not wrong.
Yes. So Niranjan, as I said, in this fund, we are looking more quality growth-oriented companies.
Right.
They would be trading at a premium as compared to the broader indices to that extent. Having said so, one of the important aspect to look at it, how better is as compared to the earnings trajectories from the broader indices. If you just compare with the small cap index or mid cap index, the growth numbers for mid cap index in last 1 year kind of stuff, FY23 numbers, mid cap index has grown a profitability of more than 15% kind of stuff. Our fund has delivered 32% earnings growth in last 1 year kind of stuff. So given that profitability is superior, you will have a higher multiple which is there. Again, we are not looking at value-based company in this portfolio. As I said, in IPO, you can be in a value trap to that extent. And consequently, we are looking quality and growth as a key metrics, and hence the valuation would look high. In our opinion, one should check P to G ratio as a more appropriate number for this fund as compared to just P ratio to that.
Right. Thanks. Another question is, while we talked about when you buy and how do you hold the stock, when do you sell a company in this portfolio? Also, a related question is, there are only 100 listed IPOs as a universe. So, how do you maintain a longer period of investment horizon? And does that shorten your investment period, and you are forced to sell a company before it starts performing well?
Great question again. To just give you sense, how do we think about a company kind of stuff? Why this is an interesting proposition? Why this fund is interesting? First is that typically when a company comes for an IPO, most of the companies don't be part of the benchmark indices, and typically it takes 6 months to 12 months, and sometimes even couple of years to be part of the regular indices. That is the time where most of the regular funds, whether it's a mid cap, small cap fund, will actually pick up these ideas. So this fund is about getting early access to some of these companies which can do very well to that extent. So the idea is for this fund is that next 2-3 years, if we are able to participate in the early growth of the story of the company, you would actually get disproportionate share of the growth of the company. For us, if you look at it, what we are talking about, this universe being last 100 IPO companies. If you look at a history of last 10 years or 12 years, 15 years kind of stuff, we have seen on an average in a year, we have 20 to 25 IPOs coming in the market. Basically, it means the universe will be valid for next 3 years, 4 years kind of stuff. That's the broad reality. In next 3, 4 years, what we are betting out at. Now, you are right. For us, the universe could be for 3, 4 years kind of stuff, which will be stable kind of stuff. So we are betting companies whether they are able to deliver profitability in next 3, 4 years or not. And if the company is able to deliver these 3, 4 years, we tend to hold these companies to that extent. And as soon as it completes 3, 4 years, I think if the company is good enough, many of these mid cap, small cap company will automatically pick up some of these companies in your regular funds to that extent. So I'm just saying your exposure to some of these companies will not go up. You will get in some format in some other funds to that extent, and you will find some new companies coming in our portfolio which is getting early access. Again, for you as an investor, if you look at it from a perspective, you want the entire cycle to be played. Just to give you sense example, people have stories whether I had bought Reliance at the IPO time, and if I held Reliance from since IPO, what money I would have made to that extent. And so what you need is that the first couple of years where people are not looking at the companies, given that they are not part of the benchmark indices, how do you participate in some of these companies? So this fund gives you that access. Yes, second question with respect to how do we exit some of these companies? What are the my exit route for many of these companies? There are 3, 4 ways where we evaluate company from our perspective. One is we think we build up model where we think about how this company is going to perform in next 3 years. We have milestones in terms of what company has promised in terms of what they want to achieve with respect to the sales growth, margin, profitability, return ratios, the working capital, the leverage ratio. Are the companies on track on many of these parameters or not? If the companies are on track kind of stuff, we typically tend to actually increase exposure, saying that they are well on track in terms of delivering. If they are not actually on track, we tend to reduce exposure to some of the companies. Second is whenever there is a change in environment in the market scenario. Just to give you sense, when we launched this fund in 2018, there was a change in market environment, especially for the NBFC space. We had an ILFS crisis. Consequently, we saw some of these financial or lending institution company were facing trouble in terms of raising capital to that extent. We thought the environment has dramatically changed for many of these companies, and consequently we relook at our hypothesis whether they will be able to make profitability in next 2, 3 years or not. If that is not the case, we typically tend to avoid kind of stuff or exit some of these companies. The third thing is when the company itself changes the plan. So I'm just saying we actually subscribe to a plan what the company is going to achieve in next 2, 3 years. In between, if the companies actually change their course of plan, there are companies where they were actually companies which were actually making the two-wheelers, ancillary companies, automatically fine day, actually they said that they want to manufacture tire also within that space. We thought we have not signed for that piece as of now, and we need to reevaluate the company to that extent. And consequently, we thought this is not a wise proposition from a capital allocation point of view, and we thought, okay, time to exit. There are companies where we thought, okay, the companies is online food delivery business, but they get into quick service delivery businesses, and consequently thought this is not an interesting idea from a 2, 3 year perspective where we don't think the profitability will be achieved, and consequently we have exited. So these are the ways where we actually exit from our portfolio perspective. For us, 3 year horizon is a good horizon to actually play for the earnings momentum. Beyond that, in our opinion, many of these companies will be, if they are good, they would be picked up by the regular set of funds.
The other question is, do you consider demerge business into the universe of recently listed? Because there will be a lot of companies, be it like Geo or some of the other companies getting listed via demerger and all. So are these considered as IPO?
No.
So
Yeah, Bhavesh, please.
Yeah. So normally the universe for us is last 100 listed IPO on main board. So we are not looking at some of the demergers which are happening, or even IPOs on SME index and all that stuff. So we are looking only at main board IPO.
Okay. So Bharat, I think so we have covered most of the questions. Uh, One last question is around a lot of investors would have invested maybe a 2 year back when we opened this fund and made it open ended. From there, I think so on an absolute basis the returns are still maybe below mid and small cap as a category, while this is a similar kind of risk return profile. What would be your advice, given that IPO markets have started to revive and there are quite interesting companies coming, and also the existing portfolio earnings growth has been robust? What is your advice for these kind of investors, and how do you see not returns, but this theme doing over the next 3 to 5 years?
Okay, my advice to these clients is that if you look at it, IPO markets will move in spurts. We will have pockets of underperformance, and then you will have pockets of huge outperformance which come in. Typically, IPO markets, the length of a good period for IPO market is typically 3 quarters to 4 quarters kind of stuff. We have seen one good quarter of IPO market, and there could be seen another couple of quarters which can happen good for IPO market if the market remains. 3-4 things needs to be in place. One is the interest rate volatility, which we have seen subsided. If it again comes back, then we have trouble to that extent. But what we are seeing, at least any incremental negative news, we are not seeing changes in the interest rate environment to that extent. So that is one key important aspect. The interest rate have to be stabilized, and if interest rates start declining, that will be an added support for many of these IPO companies. Second important aspect is that mid cap, small cap has to stabilize. What we have seen in last 3-6 months, at least the performance have stabilized and started moving upwards. Given that earning growth is superior in IPO fund, they will tend to actually outperform the mid cap and small cap. If you look at in shorter horizon, as soon as the mid caps and small cap starts outperforming or start stabilizing, people would actually separate wheat from chaff. So you would see some of these IPO companies doing better as compared to mid cap and small cap, what we have seen in it. And thirdly, if you look at it, many of these IPO companies are looked more aggressively by FIs. So as soon as the FI flow comes back, you would see actually aggressively many of these IPO companies doing well to that extent. In our opinion, people who have invested in 2021 end kind of stuff, where the peak of IPO season, my advice is that maybe that is the time where you would see some of the top-ups one can do out. Again, come through SIP route. We are not going to invest funds as soon as all IPO do come in. So I'm just saying we are not participating in all IPOs to that extent. We will participate selectively, and we will build position gradually over a period of time in many of these companies as soon as they show progress. So our view is that actually top up and participate in next 3-6 months kind of stuff to gain the maximum amount of the IPO market uptake to that extent.
Right. Thank you so much, Bharat and Bhavesh. I think so we have covered all the questions. Thank you everyone for participation, and do get in touch with your relationship manager for any further questions. We do, share quarterly notes on the fund and keep updating you on the performance. I think so it's a very unique strategy. It complements most other mutual fund or diversified funds in your portfolio. And over the longer period of time, it has a promising position in one's portfolio, and it has showcased in terms of performance as well. So thank you so much once again for your participation, and thank you, Bharat, and thank you, Bhavesh.
Thank you, Niranjan. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.